This is Cashflow Ninja, episode 76, another Wisdom Wednesday.
Welcome to the Cashflow Ninja, the podcast empowering and inspiring people to discover how to generate their own income and manage, grow, and protect their own wealth in the new economy. Now, here is your host, MC Laubscher.
Hello everyone, MC Laubscher here, and welcome to another episode of the Cashflow Ninja Wisdom Wednesday. In today's episode, we're going to jump into the infinite banking concept strategy and how it can be incorporated into your own personal economy. Now, I've talked in previous shows on the infinite banking concept as part of the Money Masters Playbook in episode 30, a more efficient and effective way to pay for your children and your grandchildren's college in episode 38, and how to maximize every dollar in your own personal economy, building your wealth capture system in episode 50, and then also how to boost your investment gains in episode 48, and how the banking system works and how you can adopt the same strategies in episode 61. Now, listeners have reached out to me and asked to explain the infinite banking concept strategy application and implementation within your own personal economy. So I'm going to start this episode again looking at the philosophical approach to the strategy. In episode 61, I covered why the banking model is such a profitable model and why the banking system is so powerful. Nash, the author of the book Becoming Your Own Banker, said, we should all be in two businesses. The business that you're currently in and the banking business. Mr. Nash, of course, referred to not opening your own bank, but reclaiming the banking function in your own life. So what does the wealthy know that does not translate to the rest of us? They know that you need to manage your own finances and family's finances like a business and also a bank. They know that you need to think like a bank, act like a bank, and become your own bank. They know that there's one pool of money out there, and they know how to capture some of that money that keeps flowing through our own personal and family economies. And they also know how to redirect more money from that large pool of money to flow into their own personal and family's economy. They capture their money and then turn it over and over and over and over and maximize every dollar, really working as hard as it possibly can, just like a bank. Robert Kiyosaki said that rich people don't do anything different than the poor and the middle class. They do the complete opposite. Let me repeat that. They do the opposite. Robert Castellone also looked at big banks and financial institutions and their model and described it as the following. Banks want your money, and they want it on a regular basis. And then they want to hold on to it as long as possible, and then they want to pay it back to you as slowly as possible. Now, every product in the financial industry follows this model and agenda. This is why Wall Street, big banks, and financial institutions love this model. So, what are they telling you? These big banks and financial institutions and Wall Street is telling the average person to park your money and don't touch it. Remember, you're in it for the long haul. Nobody can time the markets. Keep your money with us. We'll ride out the next downturn. So you have to understand that you really have to start thinking differently and run your household and your family finances like a business and a bank. After obsessively studying the wealthiest families and looking at what they do inside family offices and also looking around at different financial products for me personally, the vehicle that provides guarantees safety and benefits, unlike any other vehicle out there, is dividend-paying whole life insurance with a mutual company. It really has unmatched guarantees and benefits. Now, some of these are, it's a private contract between you and the insurance company. And it also offers asset protection in most of the 50 states. Please check with your legal advisor. The money that you put into this policy is safe, and it has a guaranteed annual growth, so you earn a certain percentage every year on this money. And then you also have the ability to participate in dividends from these companies, because as a policyholder in a mutual insurance company, you are a shareholder of the company. And most mutual insurance companies and the mutual insurance companies that I align myself with have paid out these dividends consecutively for over 100 years, throughout the Great Depression, throughout market crashes, and the last financial crisis. The growth inside this vehicle is also tax-free, and the distribution is tax-free. And you can, of course, also access your money at any time. It's liquid. Remember, this is your money. You can decide how much you put in. There are no restrictions and limitations like 401ks have, and IRAs and other qualified retirement plans. It also acts as a trust, as the death benefit is passed through tax-free to your beneficiaries or loved ones when you pass away, and it doesn't go to a probate court. So I also want to emphasize that one of the biggest risks that we face when the next financial crisis hits the shores is the institutional risk. And by that I mean where we have our money. In what institution is your money? So you want to have your money in a very well-capitalized institution, and mutual insurance companies are extremely well-capitalized with millions, some billions in excess reserves. And, of course, banks are extremely undercapitalized because of fractional reserve banking. So if everybody runs on a bank to claim their deposits, there's not enough money in the bank to pay everybody. And, of course, through the Dodd-Frank Act, the whole nature of banking basically has changed. You have become an unsecured lender to the bank when you deposit money into the bank. And, of course, in the Dodd-Frank Act bill that was passed, there are provisions that allows big banks to utilize the funds and deposits of their depositors along with the FDIC to recapitalize the bank itself. So there's bail-in provisions already in those. So you really have to be very, very careful where you have your money put away and where you warehouse your wealth. So that's what I mean by institutional risk that we carry. The other thing is market risk, which the infinite banking concept policies also eliminates, because your policy and your plan is guaranteed to go up in value every single year. So every single year it's rolled up, and then that becomes the baseline for the next year, and then it earns guaranteed interests and then dividends. So regardless what happens in the stock market, in the economy, these plans continue to grow unaffected. You also have full control over your money, and it eliminates the biggest wealth destroyers. Taxes, of course. I've ranted many, many times about the taxes being an enormous wealth destroyer. And it also limits and reduces the fees and interest that you're paying to third parties. So a portion of this money that you fund these plans with go towards life insurance, and then the majority goes into your paid up additions rider section of your plan. And that's really the part of the plan that turbo boosts your cash growth. Now, the life insurance is also a very important part for me of your wealth plan, especially if you have a spouse and children or own a home and have assets. I mean, if you have insurable interests, it's also extremely important, because You definitely want your family to have an even better quality of life if something that should happen to you. You want to be able to ensure your human life value and your future production and your income. You want your spouse to be taken care of, and you want to send your children to the best schools and have the ability to pay for their college. And you also want the family to be able to keep the family home and stay in the home, because they're already going to be affected if something should happen to you. You want them to be taken care of, and they want their quality of life to be insured along with the insurable interest of your ability to produce and provide income that would have supported this family. So the question that you might have right now is, how do I start a plan, and how does it work when I have started this plan and when I'm implementing the strategy in my own life? So first, you have to establish, of course, your flexible spending plan, which is the term I'd like to use for a budget. I don't like the word budget. It's very restrictive. So from your flexible spending plan and just analyzing your cash flow situation of your household and your family, you know exactly how much money's coming in, how much money's going out. From that, you'll be able to determine how much money is left over every month to save and put away. So hypothetically, if you have $1,500 left at the end of the month, I would really recommend the following. I would recommend that you pick an amount that you feel comfortable to put away in your IBC policies that would not put any stress or pressure on your household income. That's the first rule. So you want to be comfortable with the amount that you're putting away every single month. That means not putting away the entire $1,500 that I've used in this example. I would also recommend that you, from that $1,500, using the same example, that you would at least put away $500 a month into a separate savings account or a checking account or even a safe. From that $1,000 that's then left over, you can determine your amount that you feel comfortable in putting away on a monthly, a quarterly, or a yearly basis into these plans. So you can fund them, of course, monthly, quarterly, and yearly. And this is the deposit side of your banking system. So you're making deposits on the side, putting it into your plan just as you would in a bank. Now, as you save over a couple of years, the cash value starts to build up. Now, initially, there's a time frame where you have to fund and capitalize this plan, and this depends how much you put into the plan, and it depends how much you put into the plan, how quickly the cash value builds up. And then, of course, you have access to the money right away for emergencies and any needs that you may have. And as you build up cash value in this plan, this allows you funds for automobile purchases. You can loan the money through a policy loan from this policy to purchase a car and pay back your own banking system rather than the bank. And you can also loan money for a down payment for a home or a business opportunity or investment. Now, when you borrow the money, you borrow it through a policy loan which is not taken from your own account, but the general account of the mutual insurance company. So on the deposit side, if you want to think of it that way, you have your cash value, your own policy, where the cash value starts to build up. And then on the lending side of your own banking system, you have the policy loan side, where you loan the amount up to what you have in cash value in the policy from the general account of the mutual insurance company. So then your cash value on the deposit side still grows as if you've never touched it. It still earns interest and has access to dividends if these companies are profitable and they pay out dividends. And on the other side, you have leveraged your cash value through a policy loan and utilize it to purchase an automobile, to pay for college, emergencies, or other investments. The lending side of your banking system is how you start to maximize every single dollar that's in these policies, and you turn your money over and over and over, just as the banks do. The interest that's paid for this policy loan is usually market rate. Right now it's between 4 or 5%. It's paid back to the insurance company. So again, I just want to be very, very clear. We are not borrowing the money from our own account, our policy, like we do with 401ks, IRAs, and other qualified plans. It's a separate transaction. So your cash value is untouched, growing as if it's never been touched. And then the policy loan is a separate transaction between you and the insurance company. On the lending side, as I stated in my banking system, quote unquote. So you pay back the general account of the mutual insurance company. The interest goes to the mutual insurance company. But as a policy holder, you are a shareholder, and then also indirectly participate in the profitability of this general account and the entire insurance company through dividends. Remember, you're the owner of this banking system that you created, just like the real banks have owners. Now, when you also save for college for your children and grandchildren, this policy does not count against you when you apply for financial aid, as in 529 plans or other qualified retirement plans. And you get to use the money not just for college, but anything you want to, since, again, it's your money. So you're also, of course, encouraged to pay back your policy loans, just as you would pay back the bank its loans. You know, you never ever want to steal from your own family banking system. So the money continues to be deposited on the one side, just as in a bank, on the deposit side, and then loaned by you, leveraging your existing wealth to go and create more or buy or pay for things more efficiently. And then the money flows back into the banking system as you repay these loans, and then participates in the profits from the mutual insurance company through dividends when it's profitable. With this IBC plan in your own and family economy, you know, you will know exactly how much you will have guaranteed in your plan in 5, 10, 15, 20, and 30 years. So what other vehicle really offers this type of security, certainty, and predictability? You have to really ask yourself that question. How much of value is certainty, security, and predictability for you in your overall wealth plan? I would say that if you don't know what you have in your financial plan in 5, 10, 15, 20 years, you really don't have a plan, and you don't know where you're going. You really are at the mercy of the markets, and you're hoping that taxes stay the same, and you've pretty much made peace that you are going to pay interest to third parties and fees to financial institutions, regardless whether your account value goes up or down. As far as a family plan, IBC policies is a fantastic vehicle to set up for your child and grandchildren. If you have a newborn or a young child, I mean, just imagine putting away $2,000 to $3,000 per year for the child in these plans. And then these plans are set up as the parent or grandparent being the owner, and then the life that is insured is, of course, the life of the child. So when the child then turns 18 or 21 or 22, the parent or grandparent can then sign the policy over and give ownership to the child. So just think about the unbelievable start you will give the child or the grandchild. And of course, as they're growing up, you can teach them your wealth philosophy and the power of reclaiming the banking function within your own life and within your own family economy. This is something that the wealthiest families in the country does in their family offices. I mean, they use the same strategies to make sure that the family wealth stays together and grows with every generation. And, I mean, we do not have to be a Rockefeller or a Carnegie or an Astor to implement the same strategies in our own lives to make an enormous difference for ourselves and our families. And this is also another challenge. Don't just think about only creating wealth for yourself. We've got to think bigger. Think about creating a family legacy that will go on long after we've departed from this planet. If you're interested in learning more about this, you can email me at info@cashflowninja.com, and I'll send you a copy of Nelson Nash's book, Becoming Your Own Banker. And let me know your thoughts on the show. You guys have been amazing, tweeting me at MC Laubscher and emailing me at info@cashflowninja.com. You truly inspire me daily and really confirm every day why I do what I do. Until next time, be amazing. Live a life of passion and purpose on your terms.
You have been listening to the Cashflow Ninja with your host, MC Laubscher, the podcast empowering and inspiring people to discover how to generate their own income and manage, grow, and protect their own wealth in the new economy. Today's show notes and resources are available on our website, cashflowninja.com. This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objective, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.